the first 5 days of the August contract between gold and silver, almost $15 billion worth of stuff was delivered in 5 days. It's much more than that now. This was 2 weeks ago, but it almost all left. Where's it going? Who's buying it? Why do we not know about it? That to me signals the people doing this are very wealthy, very sophisticated, know what the hell they're doing, and they wouldn't be doing this if they didn't see where we're going with our fiscal and monetary policy and ultimately where gold and silver are going. So yes, I'm sorry to have belabored the question, which could have been answered much more easily, but yes, this will be very bullish for gold. Very, very bullish, as is the underlying fundamentals right now. Here are the numbers for silver for the first 5 days as well. So this would have been August 1st, 4th, 5th, 6th, and 7th. So they received into COMEX 1,721,192.54 ounces. That was delivered into COMEX, right? 1.721192. You know how much was withdrawn, left the exchange? 1,890,316 ounces, more left than was received. And so that's one thing, but the 1-to-1 ratio you're talking about of not rolling when they post, standing for delivery, no, there's no way it'll be 100 because it's typically 1% or, in that vicinity. To see it at 100% is, right. It's 4 feet of snow in Death Valley in July. This is very unusual stuff.
But even if it's 4 to 5% for the month, I imagine that is still very, diverged from what we normally see, correct?
Yeah, I mean, the moral of the story is not only are we seeing, players keep a lot of metal there because lots of deliveries are coming in and the numbers are going up, but they're withdrawing a massive amount of metals out of the vaults, and that in and of itself is, I think, really that's whipped cream on top of an unusual Sunday. Okay. Because it's like these things just have never happened before, and now they are. So what does it mean, and who's doing it? Who's behind it?
Where do you think this is going? I guess maybe do you think it's going into the Fort Knoxes of the world if you think it's a sovereign buyer that's behind a lot of it?
If I have a thesis, I believe, if I had to guess, if I had one guess, I would guess it's Secretary Besant under the auspice of the Exchange Stabilization Fund, where because it would be used for American security, he would not even have to run it by Congress, or at least in a very disclosed way, because I don't know, I guess who else could it be? Buffett, Bezos, a huge hedge fund. They're talking $100+ billion. Where is it going? And if you think about it, for those of you that own a mint box of silver, 42 pounds, $19,000 worth of silver, well, what are you doing with $7 billion worth of silver?
What's I was going to say? This is a lot of mass.
You're talking semi-trailers full of it. Yeah. So I don't know where it's going. It's going to some people that are incredibly influential, and that in and of itself is also interesting in that how do you keep this quiet to the point that none of the mainstream media even mentions the fact that you're seeing record inflows more so than at any time since the Bretton Woods Agreement, where everyone sent us their gold. Record. This should be talked about. It's not, and the fact that it's not, and even I spend 3 to 4 hours a day, every day, 7 days a week, reading everything I can find across the globe, and no one has a clue who's taken possession of this. This is at a high level.
What is the risk here, if any, of a breaking of the COMEX or a breaking of the LBMA under this demand?
I think the risk of breaking of the LBMA is far greater than breaking of the COMEX, because all of this gold is now coming into the United States, it seems, and I really do believe that, honest to God, believe with the passage of the Genius Act, we have entered a new monetary system, and gold will be the anchor to it, and it's not going to leave the United States. We're going to vacuum over as much as we can. It's not about tariffs, and it's not about arbitrage, like a lot of the talking heads have said all along. And I said, no, it is not. This is far more significant. The LBMA is already showing signs of breaking. You have the guy. I could scour through 50 pages of notes on here and find his actual name. I'll see if I can do it as I'm talking about it. But he used to run ICBC Bank in China. He's Japanese. He's the head of the Japanese commodity exchange, and he just came out and said that the LBMA, he said local, meaning location, London and Zurich have no platinum, zero. Virtually nothing, yet they're trading 3 million ounces a day of spot contracts that could be delivered. We've talked about silver. Silver has the LBMA has 155 million ounces of silver there. It's the lowest float that they've ever had in the history of the LBMA. Now, a float means the amount of silver backing the contracts. They have somewhere just shy of 750, 800 million ounces altogether, of which SLV owns 80% of it. So, I mean, it's owned by the ETFs, supposedly. That 155 million ounces, David Jensen is a man who has a Substack. I would have him on your show. I want to get him on mine. He's awesome. And he talks about the LBMA numbers. He says they trade about 190 million ounces a day off of a 155 million ounce float. Well, what could possibly go wrong? Well, it gets even worse than that. He says that they did a survey, the LBMA and the member bullion banks did a survey a few years ago where they said, yeah, those numbers are massively understated by as much as 10 times because they only post the final settlement numbers, not all the trades throughout the day. So they're doing 10 times as many trades as just the final settlement numbers. So what he says is they're trading 1.9 billion with a B ounces of silver per day, every day, off of a 155 million ounce float. Now, if we take a step back, and it's very similar with platinum and very similar with gold. Not as bad with gold, maybe worse with platinum. And when you look at what the Bank of England said earlier this year, we're a T+1 exchange. The LBMA. T is trade day Monday, +1 Tuesday. Wednesday, those bars need to be moving to. So, Adam Taggart owns a multinational jewelry fabricating company, and you have contracts at the LBMA, so you can make your gold and silver jewelry. And okay, we need to make stuff this month, so you trade in your contract. They say, Adam, sorry, brother. I know you're expecting those bars moving to you in 3 days, but we here at the Bank of England have a shortage of manpower and trucks. It's 8-week delay. Really? That's what you get. That's what you call getting caught with your pants down.
When you see $15 billion worth of gold and silver delivered in the first 5 days of an August contract, you should sit up straight. That's not retail stackers buying a couple of tubes of Eagles or a monster box of Maples. That's whales. That's entities so big they can move billions of dollars in physical in less than a week. And quietly. The question I ask, and I know you're asking too, is, where is it going? Who has the pockets deep enough and the sophistication sharp enough to vacuum that kind of metal off the exchanges? Because let's be honest, that's not some Reddit group pulling off a squeeze. That's not even a billionaire like Musk or Buffett dipping his toes. We're talking $100+ billion moves if the trend keeps up. This is institutional. This is sovereign. These are players who don't have to tell us what they're doing. And notice, nobody is. Mainstream media doesn't cover it. Financial press ignores it. CNBC will talk about Bitcoin ETFs until they're blue in the face, but a record exodus of precious metals from the LBMA and COMEX? Crickets. Why? Because the people doing the buying don't want you to know. Let's put some hard numbers on it. In those first 5 days of August, COMEX received 1,721,192 ounces of silver. That's what came in. You know how much left? 1,890,316 ounces. More left than came in. That is the opposite of normal. Usually deliveries are posted, most are rolled, and the net balances aren't shocking. But this time, they're not just standing for delivery. They're pulling it out of the vaults. That's unusual. That's historic. As I put it, this is 4 feet of snow in Death Valley in July. It's not supposed to happen, but it is. So who's behind it? My thesis, and I'll put this out there plainly, is that it's happening under the auspices of the U.S. Exchange Stabilization Fund, run through the Treasury. Because if it's national security, they don't have to disclose it to Congress. They can hoover up gold and silver and tuck it away without headlines. And maybe that's what's happening. Because otherwise, who? Jeff Bezos is not quietly buying $7 billion worth of silver. Warren Buffett has been down that road before, and it ended in disaster when he took 129 million ounces in 1998 and had to dump it. Hedge funds? Forget it. They don't think this way. The only entities who do are governments. The same way central banks bought more gold last year than in any year since Bretton Woods. Now let's pause. For those of you watching who own a mint box of silver, about 42 pounds, $18,000 or $19,000 worth at today's prices, you know how heavy that feels. Multiply that out to $7 billion. That's entire vaults emptied. That's cargo planes full of silver. That's why I laugh when people say silver is too bulky to move. Not if you're serious, not if you're desperate, And not if you know what's coming. What's coming is stress. Stress so great the LBMA may snap before the COMEX does. I mean, look at the structure. The LBMA has 155 million ounces of float right now, the lowest in its 140-year history. That's the float, the available supply backing the contracts. And yet they're trading 190 million ounces a day off a 155 million ounce float. And that's just what they admit to. David Jensen, who's done some of the best analysis on this, points out they themselves admitted a few years back they only post final settlement numbers. Actual intraday turnover is up to 10 times higher. So that's 1.9 billion ounces a day, every day, off a float of 155 million. You don't need to be a math genius to see the problem. That's rehypothecation on steroids. That's a casino running IOUs so fast the pit boss can't keep count. And the problem with IOUs is that one day, someone actually asked for the chips. That's what's happening right now. Instead of rolling contracts, people are standing for delivery. And then critically, they're taking it out of the vaults. They're not leaving it in the system. That's the end game. Now, the LBMA has already been caught with its pants down. Remember earlier this year when the Bank of England admitted they couldn't meet T+1 settlement? They said, sorry, it's not T+1 anymore. It's T+8 weeks. We have a shortage of trucks. Trucks. That's like your bank telling you they can't let you withdraw cash today because there aren't enough armored cars. That's not a logistics issue. That's a supply issue. That's scrambling. That's kicking the can 8 weeks down the road, hoping no one notices.
The Fed were to cut rates to help growth, as you know, we saw the unemployment numbers, the revision of the unemployment numbers were horrendous. And it's funny too, because when the May and June numbers came out, like 250, 60, 70,000 jobs created each month. Gold went down, the stock market went up, and then quietly in August they say, no, not the 400,000 or 500,000 that we thought we created. It's actually only about 78,000. I mean, it's something like that. It was a massive reduction. So you're beginning to see the economy really slow down and layoffs happen. So arguably, this is what they're going to want to do. But this adds more fuel to the inflation side, especially with M2 already at a record. M2 is taken off. So when you have this happen, more inflation without boosting productivity, because I say that to you because we see the velocity of money at all-time lows. So they're it's like pushing on a string. They're trying to get all this money into the system, but the economy is slowing. You can see it through the unemployment numbers. You can see it through the lack of velocity. There's a massive disconnection between the equity market and Main Street. Ultimately, this is all very positive for gold. Very, very positive for gold, because you're talking about an environment where gold doesn't just go up because of the currency debasement. It goes up because almost everything else looks worse. That's just the truth of it. And you add fuel to the fire when you say, since June 1st, the institutionals, the insiders, right, the traders, they've been selling between 2 and 4 billion a week in stock. And you have all of the insiders that are selling at a 7-to-1 clip. And you have Jeff Bezos selling $6 billion in Amazon since June 1st. You have the 3 or 4 biggest shareholders and board members of NVIDIA doing the same thing, and Buffett with $500 billion in cash. At the same time, you have the mainstream, or you have the public, mainstream, mom, pa, all-time record in equities, all-time record in margin debt, all-time record in option exposure. You're talking all-time levered, risky, all-in in stocks greater than the great financial crisis, greater than the dot-com bubble, and the insiders are going the opposite way. Now, to your original question. So that tells me the insiders are saying, we're leaving the sinking ship right now, something's coming, and the public is the opposite, all in. But on the metal side of things, the public doesn't have much exposure at all. But what we have been seeing month over month is extraordinary. Extraordinary in the amount of gold that's coming into this country. The people who are incredibly sophisticated know what's happening. And I want to draw an analogy to say these people typically know what's coming before the rest of us do. They are able to get the playbook. And if you look at the fact that my whole career, which will be 36 years this February, less than 1% of COMEX contracts ever stood for delivery. Now, all of the gold that's coming into COMEX, what we know of, over 100 billion since the beginning of the year, and I would argue that a whole bunch more is coming in not through COMEX. The biggest money in the world is importing gold in the United States at a level that no one has ever seen before. But more crazy than that, and I think this is a bigger indictment, and actually you got to wonder where the hell is it going and who's doing it, who's the big buyer. I think it's the Treasury, myself, or the Fed.
Now let's widen the lens. Because when we're talking about billions of dollars in precious metals moving quietly through the system, it's not just a market story, it's a geopolitical story. It's about sovereignty. It's about nations hedging against the end of an era. And you can almost feel the clock ticking on the Western system. Why would the US Treasury, or any sovereign entity, be scooping up this much metal now? My answer is simple. Because they know the Genius Act marked a pivot. That law, tucked away in the noise of headlines, quietly enabled the framework for a new monetary system where gold is the anchor. The United States is not stupid. They understand that the dollar as it exists is wobbling. Foreign central banks have already dumped hundreds of billions in treasuries. BRICS nations are settling in local currencies. And when the tide goes out, the only way to restore trust is to bring gold back into the system. Think about it. Why else would they be vacuuming metal into the United States? It's not for show. They're not putting on a gold-plated flag. They're building reserves for what comes next. And what comes next is not about tariffs or short-term arbitrage. It's about monetary realignment. Meanwhile, across the pond, the LBMA is staggering. It's not just about silver. Platinum has already been exposed. No inventory, yet millions of ounces traded daily. Gold inventories are shrinking, and the excuses are wearing thin. We don't have enough trucks to move bars in 3 days. That's not logistics. That's insolvency dressed up in bureaucracy. That's can kicking. And the numbers don't lie. If you have 155 million ounces of silver float, but you're trading 1.9 billion ounces daily, you're running a leverage ratio that would make a Wall Street banker blush. That's not sustainable. And it's not just me saying this. Analysts like David Jensen have been hammering this point. The LBMA's own survey admitted that their public numbers understate actual trading volumes by a factor of 10. They're playing musical chairs with 155 million ounces, and 1.9 billion people are circling the chairs every single day. So what happens when the music stops? Someone is left without a chair, and this time it won't just be retail investors or small institutions. This time the scramble will be sovereign. When sovereign players, China, Russia, maybe even the US itself, stand for delivery and pull it out of the vaults, that's the final crack. That's when the LBMA breaks. Let's talk China for a moment. Because while we've been asleep in the West, treating gold as a barbarous relic, China has been buying like there's no tomorrow. Month after month, the People's Bank of China reports gold purchases. Central bank buying globally in 2023 and 2024 was the highest since records began. Poland bought, Hungary bought, the Czech Republic dipped in. Countries across the global south are diversifying into gold. Why? Because they see the writing on the wall. They see de-dollarization happening in real time. They see that US treasuries are no longer the safe haven they once were. And Russia? Russia is not just buying gold. They're hoarding silver too. They're the 8th largest silver producer, and estimates say they'll produce around 1,400 tons in 2025. But instead of selling it all into global markets, they're diverting it. Stockpiling for the military, for industry, for reserves. That's supply being pulled off the market before it even reaches exchanges. And when supply is cut at the source, the squeeze intensifies. Now here's the kicker. Silver is not Basel III compliant like gold, but it is a deliverable foreign exchange cross, meaning you can trade silver against dollars, euros, pounds. And as silver supply is priced increasingly outside London's control, on Shanghai, on Indian exchanges, on direct miner-to-consumer deals, the old benchmarking system falls apart. London used to dictate the global silver price. That's ending. The price is moving east. The power is moving east. And yet the West still pretends this is business as usual? That's the illusion. But the illusion is cracking. Every time a contract is stood for delivery and withdrawn, the facade weakens. Every time a sovereign buyer drains metal from the LBMA, the clock ticks closer to midnight. Now let's get personal. What does this mean for you, for me, for the stackers watching this channel? It means you're early. You're the Noahs building the ark. And yes, your neighbors may laugh. They may say, "Why are you buying heavy, shiny rocks when the S&P 500 is soaring?" But when the rain comes, when the music stops, when the vault doors slam shut, who's laughing then? I want to tell you something that may shock you. I believe this revaluation is already underway. Quietly, stealthily. Call it a shadow reset. The US may already be accumulating to prepare for a gold-backed element in the next monetary system. And if that's true, then gold's role isn't optional, it's inevitable. And silver, as always, will follow, but with leverage. History tells us the natural monetary ratio between gold and silver is about 15 to 1. Today it's closer to 80 to 1. That's a rubber band stretched to breaking. When the snapback comes, it won't crawl back to 70 or 60. It will ricochet toward 15. And when it does, silver won't just be a monetary metal, it will be the monetary metal of the middle class. Because remember, historically, gold was the rich man's money. Silver was the money of the people. The crime of 1873 wasn't called that for nothing. When the US demonetized silver, it robbed the middle class and the poor, who used silver, to favor the gold-rich elite. So when this system collapses, don't be surprised if the foundation of the rebuild is silver, not just gold. Silver will be what circulates. Silver will be what restores local trade. And silver, the most undervalued monetary metal today, will be revalued not just against dollars, but against gold itself. That's why I keep hammering this point. Silver under $40 is unsustainable. In fact, in real inflation-adjusted terms, silver would need to be over $200 to match its 1980 high. Do I think we'll see that? Absolutely. Do I think it could happen faster than people expect? Without question. Remember, silver doesn't move slowly. When it runs, it runs. It went from $9 to $49 in under 3 years last time. This time, with deficits baked in, with industrial demand soaring, with inventories gutted, the rocket fuel is there. And let me address the skeptics. Yes, there are above-ground stockpiles of silver. Yes, India holds vast reserves. Yes, recycling exists. But those stockpiles are opaque. They're fragmented. They're not sitting in neat piles waiting to be dumped on COMEX. They're in private hands. They're in sovereign reserves. They're in industrial applications where they can't be retrieved. Jeff Christian likes to argue that inventories negate the deficit. But ask yourself this: if inventories are so plentiful, why are vaults being drained? Why are ETFs like SLV losing ounces month after month? Why is industrial demand running record deficits year after year? The answer is simple: because the silver deficit is real and the inventories are not infinite. At some point, the cupboard is bare. And when that day comes, price is the only mechanism left to ration demand. That's why silver isn't just undervalued, it's misvalued. And when the market corrects, it won't be gradual. It'll be violent. Now, you might be wondering, does this mean COMEX itself could break? My answer: not likely, because the exchanges are owned by their participants. They'll cash settle before they default. They'll change the rules like they did with nickel, like they did with tin. They'll halt trades, set arbitrary prices, and cash you out. That's why you don't want promises, you want metal. Because if you don't hold it, you don't own it. The real risk of breakage is the LBMA. That's where the float is thinnest. That's where the rehypothecation is most insane. That's where sovereign withdrawals can tip the balance. And that's where credibility is already cracking. A T+8-week settlement is not credibility. It's desperation. And the world sees it. Meanwhile, BRICS nations are building alternatives. Russia has floated the idea of a gold-backed trade currency. China has the Shanghai Gold Exchange, where every contract is backed 1-to-1 with physical. No games, no paper multiples. If you buy an ounce, there's an ounce. That's how you build credibility. That's how you build trust. And that's why metal is flowing east. Think about the irony. The West suppresses gold and silver to prop up a failing fiat system. The East buys that gold and silver at subsidized prices. And when the reset comes, the East will own the real money, while the West holds paper promises. That's the greatest wealth transfer in history happening in plain sight, and most people are missing it. So where does this end? It ends with revaluation. Whether by design, a deliberate reset, a gold revaluation account move like in 1933 and 1973, or by default through market forces snapping the system. Either way, gold and silver go higher, much higher, and those who own them before the crowd won't just preserve wealth, they'll have a front row seat to history.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.